Money supply really started to blow up in the 60s. That's why we had the high inflation of the 70s. In the 1960s, gold was $35 an ounce. Now it's $2,400 an ounce. So that's a reflection of the inflation that has been created. Of course, not just gold, but the stock market, real estate. Everything is a lot more expensive now than it was in the 1950s because of inflation. And that's just going to get worse. The pressure on the politicians to create inflation is much greater now than it was then. And they're doing it in an economy that's far weaker because in the 1960s, we still had our manufacturing base. We were still a net exporter of manufactured products. America was still the world's largest creditor nation. Now we're the biggest debtor. Now we have $1 trillion a year trade deficits. We had a lot of savings. Americans, saved money. And when they bought stuff, they weren't using credit cards. Most people who bought a car didn't take out a car loan. They paid for the car. The only real debt that you had back then was a mortgage. People wouldn't have borrowed money to buy, appliances or to take a vacation or to buy gas or groceries. Now it's just a gigantic credit bubble. So the potential for severe inflation is much greater than it was, at any point during, the 70s or the 80s or the 90s. And we've already seen that. The inflation that we've experienced over the last few years, if we measured it the same way we measured the 1970s inflation, if we had the same CPI, we would see that we actually had worse inflation during than any of the years of the 70s. And even now, where it's pulled back to around 3.5, if we measured that properly, it's more like 6 or 7, which is still very high. People want to wonder, why is Biden so unpopular when inflation has come down? Because it's still very high. Inflation is destroying the purchasing power of people's incomes, of what little savings they have. And that's only going to get worse. So the contraction is over. But people look at that contraction, you can't ignore the expansion that came before it. Because if you look at the trough of that contraction, it's still way up there compared to where we started. Tremendous amounts of money was created during COVID. And we've barely, withdrawn much of that liquidity. It's still there. And now they're adding to it. And it's going to continue because the interest burden on the national debt is already now about $1 trillion a year. It's going to be $2 trillion by the end of next year. But the government can't pay that. And it's not going to stop there. We got almost a $35 trillion national debt. But as that debt matures, it has to get rolled over at higher rates. Meanwhile, we're running $2 trillion per year plus deficit. So we're adding a couple of trillion. And that's, without an official recession. The potential is for the annual deficits to go to 4 or 5 trillion, and then we got to finance that. So the numbers are just so large at this point that inflation, I think, is the only viable option that the bankers or the politicians believe they have. There's no way we can pay the debt. We don't have the integrity to default on the debt. So we're just going to create inflation. That's the only thing they're willing to do. Now they have to deal with the consequence of inflation, which, okay, they'll blame it on other people. It's greedy corporations. They're gouging the customers. Maybe it's OPEC. Maybe it's Putin. You can create some kind of boogeyman and blame the inflation. But they're never going to accept responsibility for creating it. But that's exactly what they're doing. Stock market can always crash. It's very expensive. And so if it were just to revert to the mean, that's a big crash if it went there quickly. So it's always possible, but it seems unlikely because the Fed can always interfere by creating more money. And so we end up with a dollar crash instead of a stock market crash. And that's what I'm more worried about is the dollar crashing, not the stock market. Because in order to prevent the stock market from crashing, they'll just print a bunch of money. And so it's the dollar. So the price of your stocks don't go down that much, but the value of the money that you get when you sell your stocks, that's what goes down. The value of the dividends, to the extent that you have a dividend on your stock. Of course, a lot of stocks don't pay dividends at all. But those that do, the purchasing power of those dividends will be dramatically reduced, even if the stock doesn't crash. But the money crashes, so your dividends don't buy you as much. The big drop was in 2008. I don't think in 2006. and the market kind of bottomed out by early 09. But yeah, we had a huge rally because of QE1, QE2, QE3, 0% interest rates. The Fed did everything it could to prop up financial assets, and that included real estate. But that did a lot of damage, because what that did was prevented a healthy restructuring of the economy that would have gotten to the core of the problem that led to the financial crisis and the collapse. We didn't do any of that. Instead, we just inflated an even bigger bubble to delay having to deal with the consequences of the prior bubble. But now the disaster that we're headed towards in the future is going to be not only much worse than what we experienced in 08, but much worse than it would have been had the government done the right thing and not interfered in the process and allowed for an even bigger decline in the stock market, allowed for an even bigger decline in the real estate market, and allowed for a real healthy restructuring of the economy back in 09, 2010, 2011. Instead, we just made all the underlying problems that caused that crisis much worse, which is why the next crisis will be even worse than the last one. With the tech bubble burst 2001. And so I think a lot of money that was going into the dot-com stocks was going into real estate. And, real estate was already rising before 2000. It started to go up like 96, 97, 98. But what happened after 2000, when the stock market crashed, there was a little bit of a pause. But then real estate just took off because a lot of that money, and what really ignited it was the Fed took interest rates down to 1% after the stock market crashed. And then what people did with all that cheap money was buy houses, because now you can get a teaser rate on a 30-year fixed rate mortgage where for the first few years, your payments was 2% or 3%. And people had never seen mortgage rates that low. Prior to 2008, mortgage rates were like 8%, 9%. And, there were no adjustable rate mortgages. There were no teaser rates. And all of a sudden, money became very cheap and lending standards went down. You didn't need a down payment. You didn't need to document your loan. You didn't even have to prove your income, right? The liar's loans came into play. And so a lot of money was, going into the real estate market. And of course, as real estate started to go up, it sucked in even more money because of the leverage. Because all real estate has to do is go up 10%. If you put 5% down, and real estate goes up 10%, you've doubled your money, right? And so that's what people were doing. Goes up 20%, you've quadrupled your money. People were getting rich, you remember, in 2005 and 6. Kids that got out of college and that just happened to buy a condo were getting rich because they bought that condo. They were making way more money on their condo than at their job. And then their friends who didn't buy, who rented, were very jealous because they didn't have any of the money, right? They were paying rent. And so that created even more incentives. Everybody, had to keep up with the Joneses. You talk about FOMO. There was tremendous FOMO in the real estate market. You had to buy a house. And then people, well, if one house is good, 2 are better than 3. People were buying multiple homes because you couldn't lose. The real estate market is much higher. I mean, real estate prices are hit record highs, right? Because the bubble popped, because a lot of the buyers of the subprime loans went back, they wouldn't buy them anymore when they all defaulted. They couldn't get the credit. A lot of the teaser rates matured. And even though the Fed had lowered rates, they still weren't low enough for those teaser rates. But also, you had the dynamic of when people buy a home, let's say I paid $500,000 for a house and it's only worth $300,000. Why am I going to struggle to make the mortgage payment? There's no reason. So a lot of the defaults were a result of the economics. People made rational decisions, which is why it was so stupid for banks to let people buy homes with no down payments or such low down payments, because it was easy for them to walk away from a home where they had no skin in the game. And so there were a lot of other dynamics, but none of this would have happened but for the government guaranteed mortgages and things like that. But, we have a very different situation right now, because in 2008, the banks were in trouble because of mortgages that were in default. People weren't paying because the house had lost value. And so that was bad for the bank, because not only were they not getting the payment on the loan, but the collateral was not worth what they had loaned. So they were sitting on these losses. But the losses were really only a problem to the extent that the homeowner wasn't paying the mortgage. If the homeowner was paying the mortgage, they were fine, right? And of course, their commercial portfolios were in great shape because they were all paying, and low interest rates really increased the value of their commercial real estate books. And it was very easy for commercial borrowers to refinance at even better rates. So they were in good shape. But today, I argue that the banks are in much worse shape than they were in 2008 when so many of them failed. And that's because they're losing money on all their mortgages. Every mortgage that they own, they're losing money on because they're sitting on mortgages where they're earning 2, 3, 4%, but their cost of money is 5%, 6%. So they're losing. They're not getting money at zero anymore. So mortgages that were profitable when interest rates are at zero, they're losing money on. And so it's not just the mortgages that are defaulting. In fact, if somebody defaults, that's a relief for the bank. They want people to default because then they can sell the house and rip up the mortgage. But people won't default because they want to keep those mortgages because the mortgages are actually assets to the homeowners because they've got all this cheap money locked up for 25 years. They're liabilities to the banks. The banks would actually pay you to pay off the mortgage. They get rid of it. So the banks, I think, are in worse shape. And there's a commercial real estate crisis. Prices have crashed. Banks are losing a fortune on their commercial real estate. So they're losing on their commercial because of defaults. They're losing on the residential because of higher interest rates. It's the value of the mortgage that's crashed, not the house price. And I always said to people when, they would call up my show and they would ask me, if they should buy a house. And I would say, well, as long as you take out a 30-year fixed rate mortgage, you got to take out the mortgage because ultimately, from a financial perspective, you're going to make money on your mortgage, not your house. That's the opportunity. It's not buying a house. It's borrowing money for 30 years at 3%. That's what you want to do. And the only way you can get that loan is to attach it to a house. So go out and buy a house and get that cheap money because inflation is going to wipe it out. And then meanwhile, your payments are low, and so that's what people are doing. But though that was bad for the banks. And I kept saying, and nobody else was talking about this because everybody focused on how great it is that people can refinance their mortgages and reduce their payments. And I would say, yeah, it's great for the borrower, but what about the lender? The lender is having their income reduced, right? Whenever somebody refinances their mortgage and they were paying $3,000 a month and now they're only paying $2,000 a month, that's a huge loss for the lender. Now, the only reason the lender was able to eat that loss was because the Fed had rates at zero. But I kept saying they're not going to stay at zero forever. What's going to happen to the banking system when interest rates go up and the banks are sitting on all this underwater paper? We know Silicon Valley Bank, Signature Bank, these banks started to fail. And more banks would have failed if they didn't come up with this bailout plan. But I think the entire banking system is completely insolvent right now. And it could collapse any day.